So here we are in early 2026, and the market is at a total crossroads. After an incredible run, every single investor is asking the exact same question. Today, we're going to break it all down and figure out what it means for your money.
I mean, you look at the charts, we're hitting all-time highs, right? But then you read the headlines, and it's this crazy mix of optimism and, well, fear. So, are we looking at a golden opportunity for another leg up, or are we staring at a dangerously high peak? The answer could really define your portfolio for the next few years.
To get to the bottom of this, we're going to laser focus on one key player, the Vanguard S&P 500 ETF. You probably know it as VOO. By really digging into this one massive fund, we can get a super clear picture of the entire US market. Let's dive in. All right, here's the game plan for today. First, we'll get to know VOO itself. Then we're going to lay out the bull case and the bear case, check the valuations to see what the pros think, deliver our final verdict, and then we'll talk about an alternative play you need to know about.
Okay, first things first. Before we can even talk about where the market is going, we have to understand our main tool for measuring it, VOO. So what is VOO, really? Yeah, sure, on paper it's an ETF that just tracks the S&P 500, but look at that number. Over $872 billion in assets under management. That's not just a fund, it's a behemoth. It's basically a real-time pulse check on the health of the US economy and where money from all over the world is flowing.
And right here, this is VOO's superpower. It's competitive moat. That ridiculously low expense ratio of just 0.03%. Think about it like this. For every $10,000 you invest, you're only paying $3 a year in fees. That is a tiny fraction of what its main competitor, SPY, charges. For anyone investing for the long term, that small difference compounds into thousands and thousands of dollars in your pocket over time. But, and this is a big but, there's a major risk that comes with VOO, and that's concentration. Just look at this. The information technology sector makes up over 28% of the entire fund. You know, this feels a little familiar, kind of like the dot-com era. It basically means that the fate of just a handful of mega-cap tech companies is steering the ship for the entire market. That's a huge factor to keep in the back of your mind.
Okay, so now that we know what we're working with, let's look at the bright side. What is the bull case? Why might this market just keep on roaring higher from here?
Take a look at this number, plus 2.6%. That's Goldman Sachs' forecast for US GDP growth in 2026. And let me tell you, that is way above what most other analysts are expecting. It suggests the US economy could just blow past its global peers. So, what's fueling all this optimism?
Well, it really boils down to three big things. First, you've got fiscal stimulus from the One Big Beautiful Bill Act, which is pumping up the economy with corporate tax breaks. Second, the AI investment boom is just on fire. It's driving a huge productivity wave and is expected to boost S&P 500 earnings by a massive 12%. And third, pretty much everyone is betting that the Federal Reserve is going to start cutting interest rates later this year.
All right, but it can't all be sunshine and rainbows, right? There are some pretty serious storm clouds gathering on the horizon. So let's flip the coin and look at the bear case, the things that could go seriously wrong. This number, minus 17%, should give everyone a little pause. Historically, in midterm election years, just like 2026, the S&P 500 has seen an average drop of 17% at some point during the year. Political drama and uncertainty almost always lead to sharp market volatility, and this year is definitely shaping up to have plenty of that. And this quote from Goldman Sachs really hits the nail on the head. It's all about elevated multiples, which is just a fancy way of saying stocks are expensive. The market is basically priced for perfection, which means if earnings disappoint even a little bit, well, there's a long way to fall. The margin for error is razor thin. So the bears are focused on three major headwinds. 1, those sky-high valuations we just talked about. A forward PE ratio of 22, we're getting into dot-com bubble territory again. 2, sticky inflation. What if inflation comes roaring back to, say, 3.5%? The Fed would have no choice but to slam the brakes on those rate cuts everyone is counting on. And 3, geopolitics. You've got flashpoints all over the globe that could spook investors at any moment.
Okay, so we've got a really compelling bull case on one hand and a pretty scary bear case on the other. So where does that leave us? Let's check out the valuation and see what the pros on Wall Street are actually forecasting for the year. So here you have it, the year-end targets from the big banks, and yeah, they're all over the map. From Oppenheimer's super bullish plus 17%, all the way down to Bank of America's much more cautious plus 2%. But the number to really focus on here is that median forecast. The consensus view on the street is for a solid 10% upside, putting the S&P 500 at a target of 7,650.
So what does that actually mean for you if you're a VOO investor? Well, if we translate those Wall Street targets, we're looking at a potential price range from a low of about $653 to a high of over $750. But that all-important median target, that translates to a VOO price of right around $697. All right, the moment of truth. We dissected VOO, we've laid out the bull and the bear arguments, we've seen the professional forecasts. It's time to make the call.
Based on everything we've seen, our verdict is a buy. Now look, the risks are absolutely real and we are not ignoring them. But we believe the powerful tailwinds from fiscal stimulus and that AI-driven earnings cycle are just too strong to bet against right now.
And we're putting a number on it. We are setting a 12-month price target of $697 per share. This isn't a number we just pulled out of thin air. It's based directly on that median Wall Street consensus forecast, which points to roughly 10% upside from current levels.
So let's just be crystal clear on the core thinking here. Our buy rating comes down to one primary driver: resilient corporate earnings growth, which is getting supercharged by both fiscal policy and the AI investment cycle. The single biggest risk that could derail this whole thing is an external shock, something like a major geopolitical event or a sudden return of inflation that forces the Federal Reserve to change course.
Okay, one last thing before we wrap up. Let's talk about an alternative play. Because while VOO is an amazing choice for most investors, it's not the only game in town when it comes to tracking the S&P 500. When you're looking at VOO versus its big brother SPY, it really all comes down to your personal strategy. Are you a long-term buy and hold investor? Then VOO is your best bet, period. That ultra-low cost is going to save you a ton of money over the years. But if you're an active trader, someone who needs to get in and out of positions quickly, then SPY is still the undisputed king. Its daily trading volume gives it unparalleled liquidity, and its options market is way, way deeper, which is crucial for more complex strategies. It's all about picking the right tool for the job. So there you have it. The outlook for 2026 seems, well, cautiously optimistic. The bull case looks strong, but you have got to keep those risks in mind. Now, we want to hear from you. What company or ETF should we put under the microscope next? Drop your suggestions in the comments below, and of course, make sure you subscribe for our next deep dive.